Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll top fire. Good God. We can't look at this, guys. Like, my strategy is you buy it and you hope that you guys buy it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hold on a second. I am not ready here. Dude, we have CPI. It's a big deal. Start. All right. Let's just go really quickly here to some of the charts. As the treasuries are down another big move, they must really be expecting a bad CPI report. Biden administration saying they're expecting a bad CPI report, but that has been a contrary indicator as of late. S&P 500 coming back from yesterday's excellent rally a bit as optimism over the talks in Ukraine wane, and that means also oil recovering a little bit, and gold and silver, gold back over the 2,000 level. And we come back over here. Bitcoin giving up the gains that it had made yesterday, doing a BART here, and the dollar still relatively low from recent levels, 98. Although just remember, you know, we were much lower not too long ago. So coming back over here, we've got this CPI news coming out in 30 seconds. Man, I'm behind. Now, I am not going to be taking a trade on this. This is likely to be really crazy, right? So they are expecting. Now, why is it not showing me the core CPI month over month? They're expecting spot 5.
0.5%, sorry, 0.8%, 0.8%.
That's in line. Core is in line, 0.5.
8%. US
Charts tell all the story. No, they don't.
27K.
Oh, they don't, but that's okay.
7K. That is higher than the forecast of 217K. US CPI year on year, 7.9%.
Okay, so the number comes in line, and I'm seeing lots of shorts unwind here.
6.4%, in line with the forecast of 6.4%.
S&P 500 likes that. I like that too. I think that's worth a buy somewhere in here in the S&P.
In the US core CPI month on month, 0.5%, 0.5%, in line with the forecast of 0.5%. Taking a look to the markets,
try and work something out here.
And some upside movement in the S&P 500 and Bitcoin. So now the USDA, US net wheat export sales at 307.2.
Now, the issue that we have here in treasuries is that we also got the
sales
ECB today. So
3K, 2,204.3K, and the US net corn export sales 2,143.7K, 2,143.7K.
I think that you should post a broker statement showing that you just made money if you're going to talk like that, Crypto Pop. Because I really hate people that talk big and don't show it like that. Especially when they say things that are empirically false. Yep, we have a LaGuard press conference. Dude, we love LaGuard press conferences. They're great. We need to keep an eye out for, you know, new moments that we can use in part of our LaGuard's Greatest Hits series. Right? Why am I still getting...
The US CPI report for February 2022, now available on the feed for those interested.
There are some user accounts that are still able to come in and post links and stuff. And I don't know how they do that. I don't know how they do that. They're getting around my filters. And your NQ DOM is broken?
Available on the feed.
What? Yeah, well, they don't. She doesn't speak quite yet, does it? Or does it? Is there? Oh, it is right now. Yeah, you're right. Silly me. Silly me. You do flash. I'll find it.
And ECB's President Lagarde has
turn on your
started
camera
speaking
so
at
that we
the
can hear and
ECB
see
press
you
conference
when
event.
you ask a
Again, the
question.
live video for that is available
I
slightly
will
down the
now
feed
give
to
the
watch
floor
along.
to President
Lagarde
Lagarde.
stating that the
President
Russian
Lagarde,
invasion
please.
is a watershed for Europe and that the ECB will ensure smooth
Thank you very
liquidity
much,
conditions.
Wolfgang.
Okay,
Good afternoon.
let's turn that off.
The Vice President and I welcome you to our press conference. The Russian invasion of Ukraine is a watershed for Europe. The Governing Council wants
Looks
to
like my
express
stream is a
full
little
support
bit behind,
to the
but that's
people
okay.
of Ukraine. We will ensure smooth liquidity conditions and implement the sanctions decided.
There is, or you should, yeah. So we should note that today is the roll for the equity indexes.
Needed to fulfill the ECB.
So particularly in NQ, you might see some bizarre things.
Financial stability.
You have a spread of 10 points? What?
The
Okay,
Russian
let me see here.
will have a material impact on economic activity and inflation through higher energy and commodity prices, the disruption of international commerce, and weaker confidence. The extent of these effects will depend on how the conflict evolves, on the impact of current sanctions, and on possible further measures. In recognition of the highly uncertain environment, the
Where
Governing
is my
Council
NQ? I know I
considered a
have it on
range
here.
of scenarios
There it
today's
is.
meeting. The impact of the Russia-Ukraine war has to be assessed.
No, I don't have a spread that big.
Solid underlying conditions for the euro area economy.
There's March. March is still pretty tight.
The recovery of the economy is boosted by the fading impact of the Omicron
Now let's try rolling.
variant. Supply bottlenecks have been showing some signs of easing, and the labor market has been improving further. In the baseline of the new staff projections, which incorporate a first assessment of the implications of the war, GDP growth has been revised downwards for the near term, owing to the war in Ukraine.
You know what? I shouldn't have done that. Hold on.
Growing at 3.7% in 22, 2.8% in 23, and 1.6% in 24. Inflation has continued to surprise on the upside because of unexpectedly high energy costs. Price rises have also become more broadly based.
Oh, you rolled to June?
The baseline for inflation in the new staff projection.
So you're saying June's not very thick, huh?
Revised upwards significantly, with annual inflation at 5.1% in 22, 2.1% in 23, and 1.9% in 24. Inflation, excluding food and energy, is projected to average 2.6% in 22, 1.8% in 23, and 1.9% in 24, also higher than in the December projections. Longer-term inflation expectations across a range of measures have re-anchored at our inflation target. The Governing Council sees it as increasingly likely that inflation will stabilize at its 2% target over the medium term. In alternative scenarios for the economic and financial impact of the war, which will be published together with the staff projections on our website, economic activity could be dampened significantly by a steeper rise in energy and commodity prices, and a more severe drag on trade and sentiment. Inflation could be considerably higher in the near term. However, in all scenarios, inflation is still expected to decrease progressively and settle at levels around our 2%
There we go.
inflation target in 24. Based on
Let me
our
out. Cool.
updated assessment and taking into account the uncertain environment, the Governing Council today revised the purchase.
She is like way too serious for this situation. And what I mean by that is like, obviously the situation is serious, but I don't think that you want to give everybody this super serious feeling, you know?
30 billion in May and 20 billion in June. The calibration of net purchases for the third quarter will be data dependent and reflect our evolving assessment of the outlook. If the incoming data support the expectation that the medium-term inflation outlook will not weaken even after the end of our net asset purchases, the Governing Council will conclude net purchases under the APP in the third quarter. If the medium-term inflation outlook changes, and if financing conditions become inconsistent with further progress towards our 2% target, we stand ready to revise our schedule for net asset purchases.
So, by the way,
size.
the Biden administration did try and sandbag us again. It seems to me that it is a pretty reliable indicator that if the administration comes out and warns about a number being bad, that it's actually going to be good.
And will be gradual.
It's every single time that they've done it,
The key ECB
they were sandbagging.
will continue to be determined by the Governing Council's forward guidance and by its strategic commitment to stabilize inflation at 2% over the medium term. Accordingly, the Governing Council expects the key ECB rates to remain at their present level until it sees inflation reaching 2%, well ahead of the end of its projection horizon and durably for the rest of the projection horizon, and it judges that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term.
You're so full of shit, dude.
To confirm our other
I'm
policies
sorry. You're saying things that are just objectively false.
published today at 1:45.
Yeah, obviously you can't trust the Biden administration.
Now outline
That's-
in more detail how we see the economy and inflation.
But the charts do not show you the unbiased truth at all.
Our assessment of
The
financial
charts is only a reflection of the orders that went through, and they do not reflect the
economy grew
fundamental
by
information.
5.3% in 21, with GDP returning to its pre-pandemic level at the end of 21.
You bought into a lie.
Slowed to 0.3% in the final quarter of 21 and is expected to remain weak during the first quarter of 22. The prospects for the economy will depend on the course.
It's not just my opinion, it's an empirical fact that has been backed up by numerous studies.
Financial sanctions and other measures.
I don't listen. Unlike you,
Time, other headwinds.
unlike some people, I don't just mouth off my opinion about technical analysis and, you know, whether this is a good trade or that's a good trade. If I'm going to tell you something, I'm going to have a good reason to tell you, and I'm able to back it up.
Before the outbreak of the war. Measures to contain the spread of the Omicron coronavirus variant
So you claim, go do it, go fine.
than during previous
I've given you the information.
being lifted.
We have a video
The
about the inelastic market hypothesis that I think pretty well explains it.
Signs of easing. The impact of the massive energy price shock on people and businesses may be partly cushioned by
Crypto
the volume
blows,
of
yeah.
savings accumulated during the pandemic
So you know here that so first of all, there was a big BART over the whole, administration's announcement on, or executive order on cryptocurrencies. Then they tried to buy Bitcoin off of this CPI, and that came back real quick on them.
The global recovery.
I'm telling you, like every major news event that happens, there's somebody trying to pump Bitcoin and saying, "Oh, it's a good thing for Bitcoin," and then it will come back.
Remains critical, especially in this difficult geopolitical situation.
Like, if you want an example of how markets are not informationally efficient, that is the absolute perfect. That is the absolute perfect example.
We expect it to rise.
You come in here, all of these retards that think that the chart tells you everything, they're going to come in and they're going to say, "Oh, look, Bitcoin moved up because of the Biden's executive order. That means that the market likes it. We need to buy Bitcoin. It's going to go to a higher high here, and we're off to the races." And then what happened? Whoever it was that bought there gave it all up and lost money.
And the higher price of fertilizers. Energy costs have risen further in recent weeks, and there will be further pressure on some food and commodity prices owing to the war in Ukraine. Price rises have become more widespread.
Now, if it works for you, that doesn't necessarily mean that the rest of the class wants to hear about it.
To levels above 2%.
That's not how it works. That's exactly what happened, Crypto Pop.
Consistent the rise in these indicators will be, given the role of temporary pandemic-related factors and the indirect effects of...
You say everybody knew to fade that pump, but I saw so many people out there buying off of that. Man, you got to be kidding me.
For longer than previously expected, but will moderate over...
Well, the chart very clearly says that you don't want to fade this particular move because
stemming from global...
it didn't. I don't know. Let's see. If we're right here. Okay, wait.
Conditions have continued to improve.
Okay, we're right here. How do you know to fade that? Would love to know.
Labor shortages are affecting more and more sectors. Wage growth remains muted overall.
Yeah.
Over time, the return
Gold,
of the economy to
crypto is all in the cloud, something the government can always take control of it. It seems to me that if the U.S. government really wanted to do something about it, they could, yeah.
Inflation expectations derived from financial markets and from surveys stand at around 2%. These factors will also contribute further to underlying inflation and will help headline inflation to settle durably at our 2% target. The risks...
You made big money off of cryptocurrencies? It doesn't impress me.
With the invasion of...
It doesn't impress me. I've made good money off of cryptocurrencies too. Not like millions of dollars, but I've made a few thousand from it. From nothing. Literally nothing. It's like taking candy from a baby, man.
On economic sentiment and could worsen supply-side constraints again.
Bitcoin to the moon. They're not doing so well today.
High energy costs.
I don't know. I'm not seeing in my metrics or in the sentiment a collapse here at the moment. I think that they're going to fight for somewhat longer, but I definitely have some fears once, it's that 30K level. And it's not anything in the charts. It's just that's where all of these big guys like Michael Saylor and stuff, all of their positions are in the 30s, right?
Rises, or if there are adverse, persistent supply-side implications.
Okay, you made one good trade. That's great. Show us your 5-year record.
Over the medium term.
Then maybe I will believe you.
However, if demand were to weaken over the
Trudeau just froze assets like it was nothing. People couldn't even buy groceries. He even took people's crypto. You did.
The Russian invasion of Ukraine has caused substantial volatility in financial markets. Following the outbreak of the war,
Sooner or later we will moon.
market interest rates
I think that it depends on regulation, of course, but crypto is probably not hit its all-time high.
the financial sanctions against Russia, including the exclusion
It depends,
of
though.
Russian banks from SWIFT.
Like I mean, you've been here before, Anthony. You understand, right? If the government comes in and destroys the Tether, right, and Bitcoin crashes because of Tether, that could really hurt trust in Bitcoin and could
Fewer non-performing
prevent Bitcoin from ever reaching a new high. That's the big risk in Bitcoin, right?
profitable as
I don't know if that's the scenario that's actually going to play out, though.
bank lending rates.
Government might be nice to them and kind of let them unwind it slowly.
Rates for household mortgages remain steady.
Show me yours. Well, I'm not the one that's making a claim about my performance.
Firms have declined,
I don't.
increasing strongly.
There would be nothing impressive about my 5-year performance record.
Lending to households.
I'm pretty sure that if you looked at 5 years, that it would be negative. You're the one that's making a profitability claim and trying to claim your own trading as evidence of your authority.
And has significantly increased uncertainty. If the baseline of
I'll only accept 10 years of in the money trades. Well,
the economy should
listen, 5 years is the base standard, that's all.
the declining impact of
I only say 5 years because I know that almost everybody that comes in and starts saying stuff like that hasn't even been trading for 5 years. That's why I pick 5 years.
level would also help.
Like I just know that somebody that's been trading that long and is that successful that wouldn't talk like this.
And taking
You know?
into account the uncertain environment, we revised our schedule
If you've been around for that long,
in
you
the coming months,
start to get cynical.
confirmed all our other policy measures.
You buy like never the
We are
huge
very
dip.
attentive
The huge
to
dip could happen.
uncertainties. The calibration of our policies will remain data dependent. And
Well, the thing is if the huge dip happens, I would probably buy it too. But
to adjust
that doesn't mean that they'll make it to a new all-time high, right?
so that inflation stabilizes at our 2% target.
Last time I had to prove my performance, I became a father.
I'm ready to take your questions.
Okay, question time.
President Lagarde.
Let's see what they do.
First question goes to Caroline Look of Bloomberg News. Caroline, please.
Hi, good afternoon, President Lagarde, and thanks for taking my question. My first one is, a lot of the recent communication from the ECB has been about how supply-driven the current inflation and even core inflation surge is. So how much agreement was there in the Governing Council about accelerating the pace of normalization now? And secondly, your new guidance states that interest rates will follow some time after net bond.
Mm-hmm.
So does that mean that
Please,
we're back to
don't come back. Seriously.
or how does
I'm not interested
with the
in
significantly higher inflation projections you just presented?
people that want to come in and boost their own ego, make unfounded claims, and tell people things that are misleading and harmful to them.
Of a
So,
Governing Council.
Yeah.
We
And
had
obviously, that's just the classic, isn't it, guys?
discussions
As soon as you start asking them for a 5-year record, they shut up and they leave.
about the uncertainty.
It's like,
And as with
this is like clockwork.
institutions,
What he's really thinking here,
communities, families,
he wants you to think, oh yeah, see, I'm super smart and I know everything and they're all gonna come and follow after me because, I said that I made money. But what they're really thinking is, yep, there's the 100th wannabe guru coming into the channel that isn't able to put up isn't able to back up their claims. And as soon as somebody asks them to back it up, they run away. That's like, it's been a while, right? It's been a few months since we've had this. It used to be like an everyday sort of a thing. I'm not projecting much at all. Listen, I am 100% open with you guys. Every trade that I make is here on this stream, and you can watch it. And I'm very direct with you guys that if futures trading is hard, I don't always make money. You're probably not always going to make money. That in the long run, you're probably going to blow your account. Okay, we understand that stuff. Hey, Stick, how are you doing? Oh, okay. Good. I'm glad I know that, because I would have been like, who's Jermax? Why is he a moderator? Anyways, I don't have to sit and put up some sort of false front to try and get people's respect, right? Because I have facts. You see, I can go and I can look at. I'm kind of in a unique position for you guys, right? Because I was somebody that was close enough to see how the professionals do things, but not actually be a professional. So that, because if I had actually been a professional, if they had actually taught you that stuff, it probably wouldn't be getting on YouTube and telling you what they had taught me, right? But because I learned it all on my own, just from the few little hints that I had seen in the firm, I'm able to give you this information. And I'm able to give you facts, because this is all based on empirical research. These studies that you can go and read that are developed at or written by the top researchers in the world at Harvard and Stanford and all of these universities, right? So I don't have to come in and say, well, you should believe me because I've made so much money. And then that one day that I blow my account, I have to try and hide it and not let anybody know that that's what happened, because then they'd never listen to me again, right? The people that come in here understand that, we're here for fun, that trading is hard, and that we're here for the camaraderie, and that the information that I'm going to share with you is verifiable information. And that's how I'm able to have the clout that I do. It's because my clout's not based on my performance. It's based on empirical research, facts. And it's so funny that any time that somebody comes in and tries to make that argument, you should listen to me because I made the money. Once we start to poke around, we find out that they didn't have the performance. For instance, CryptoPop, not willing to show us a 5-year track record. You know why? Because he doesn't have one, probably. Probably he's only been trading for a year or two. Based on the way that he talks, probably only been trading for a year or two. Post-pandemic, my guess. I like your style, bro. Thank you very much. Let's hear what happened. I changed my name. Oh, what? Why would you try and share somebody else's course? It's not even worth it, probably.
We are clearly identifying.
I don't know too much about that guy. I've certainly heard his name. There's been drama around him before, but I don't really know him.
We can decide sometime after net asset purchases.
It's a bear market in crypto. Some traders needs money. Yeah.
To rates. In terms of timeline, we're also saying that we will end net asset purchases under those data that I have just described.
I have to say, I don't know how to combat this people's nature, right? Because people's nature is go and find the person that claims to be making the most money and try and do what they were doing. And all that's ever going to do is lead you to people that are trying to scam you, because the people that are going to have the best performance claims are full of shit, right? Like that's the thing, is that the people that have been really successful at this and have been doing it for a long time, you look at their results, you might not be all that impressed. Because guess what? Futures trading is super hard. Day trading, super hard.
I've explained it with this response. I hope so.
And if if they are able to show you those results, they're probably lucky. Like you got to realize, like it's like a 1 in 1,000 chance that you're going to find that person that really truly made millions of dollars over 5 to 10 years.
Because on the surprise factor you actually introduced today.
No, that's not a way to start a YouTube channel. Come on.
Convinced that you're going to pause and not change anything because of that heightened uncertainty. So perhaps you could elaborate a little bit on the thinking in the governing council on that issue to.
Well, but tell me, what is in that course that you find valuable?
And then I'd like to go back as well to the rate question. Of course, sometime after could mean.
Oh, he doesn't even sell it anymore. Yeah, but what
Back to that.
is I don't know. I've never watched it.
If things develop according to
No, dude, that's not the way to do it. Come on.
this year.
Oh man.
Fine.
Give people valuable, useful information, right?
I don't know what is your dominant.
There's something in every one of my videos that is very valuable to trading that you're not going to find anywhere else, right? Every one of my videos.
Of those scenarios.
I'm very proud of the channel that we've made here, man.
Suffice to say,
I'm very proud of it. I don't think that we get
those who make
the attention we deserve, but that's okay. You know, it's probably my fault. Maybe I'm not the most engaging guy sometimes. You got 10 subs, that's great.
People around the table who look at what their mandate is, what the projections deliver, what the medium-term outlook for inflation looks like, what the risks are, what the uncertainty is, and on the basis of all that, who are trying to deliver a predictable course while being very cautious. That's really what we did. And,
I mean, I would be interested to see what his approach is like, because I don't know anything about the guy, but I have one friend that talks to him a lot, apparently, but I don't know what his results are like. I have to say, though, every time that I've looked at a course, I'm disappointed in the content that they provide. Like the amount of content and the quality of the content is always disappointing. The only piece of content that I've ever purchased that I really thought really gave substance that was worth it was the Trades, Quotes, and Prices book. And that's only like $70. I must say, the No BS Day Trading book, I really like that one. I'm not necessarily going to say that it has a ton of substance, but in terms of its ability to describe to you how the game works and what's happening and kind of set you off on the journey, it was just the perfect starting point, you know? So I really, really like the No BS basic course.
The Governing Council looks at all the data to determine whether it is time to hike rate or not. And clearly,
yeah, I'd have to look at it.
Is all-encompassing.
It's interesting that he doesn't put it out anymore, though.
But it can be
It's just kind of funny. It's like, man, I could everything that I've put on this YouTube channel, I could put it into a private course and sell for $1,000 a pop.
Is not what to matter most. It's the data.
I need to write my book, man. I need to find the time and I need to write a book.
To assess medium-term inflation outlooks.
There's still a lot of content to come. Now, everything that I wrote about developing a strategy and order flow, I wrote all of that down, so that can all go into the book.
Thank you.
Or be the base for the book.
Thank you, Madame Lagarde. The next question is for Francesco Canepa of Reuters.
Does the No BS course give you strategies that work? Not exactly. So the No BS strategy does give you specific setups. For instance, they talk about catching the edge and they talk about icebergs.
Francesco, can you hear us?
But if you just try and take the setups that you see, every time that you see that, you're not going to make money, right?
In the meantime,
and he will say, well, you have to know what the context is, and based on the context, you'll know whether to take that trade long or short.
Taking my questions.
Well, maybe, but when I was trying to trade just those signals, it didn't work for me. It didn't work for me, and I think that it's another one of those cases where it was probably a lot more effective when he was using it at a prop shop, but the market has changed a little bit. That doesn't mean that the setups are useless, though, right? It just means that you're going to have to have more on top of it.
For the financial stability. And then a second question is actually on digital currencies. I know you made so many decisions today, but EU sanctions targeted the central bank of Russia in an unprecedented way.
Yeah, well, the treasuries, they popped off on the CPI,
Digital currency.
but they've come right back to where they were.
Is going to
And what about the equities?
for the digital euro? Thank you.
Yeah, Bitcoin is a little bit lower now.
Thank you, President. I will try to answer your question on financial stability. Well, it's quite clear that we have seen since the beginning of the invasion.
That's a lot of
volatility.
Lots of volatility in the treasuries.
But I think that perhaps
ES came back to.
I would like to stress is that
actually a little bit lower here.
Not comparable to the one that we had 2 years ago. Liquidity has not disappeared from the markets, and despite the situation of tensions that we have seen in certain financial and capital markets, well, liquidity, as I have said before, has not disappeared. We are closely monitoring different financial markets.
You use just a. I'm actually no, you do not.
As well, we are.
No, you do not.
Looking at what's happening with corporate
RSI.
In terms of corporate bonds, spreads have widened, but as I said before, liquidity has not faded out.
Is order flow what they call reading the tape, and how many years have you been looking at the tape? Well, so I've been watching the tape since 2016, basically.
And mainly,
so it's been about 6 years now.
Commodity derivative market.
I was involved in markets before that, but that's when I started reading the tape.
Any sort of special
but some people might have different definitions of what reading the tape is. That's why the keyword that you search for if you're looking for this stuff is order flow.
We are closely monitoring the situation.
And
finally, in the gold bond market,
because some tape readers were only just hearing the prices read out and how fast they were changing.
So the conclusion is
weren't actually seeing the orders.
Russia is
versus what we're doing. We're seeing the orders. We're seeing the limit orders, or
But in terms of the exposure of the financial sector,
what does polling liquidity mean? So polling liquidity is what we refer to is our word for canceling a limit order.
It's only 2% roughly of the world.
So if a market maker comes in and cancels a lot of their limit orders, they pull their liquidity. You have a very illiquid market. We still have a very illiquid market here, right?
Are not
every price below 1,000 lots in the 10-year.
And on your question concerning CBDC, you know my views on CBDCs, and you know that I have pushed that project.
I think we know after finally being allowed to answer a question. He talked for like 5 seconds.
With a high-level task force.
What if the Fed doesn't execute that in that manner?
In a way,
first of all, it's not the Fed that does it, right? It's the Bank of New York.
The role that cryptos can play,
and they're more about executing block orders than market making.
When they are implemented.
Do you try and spot big money and follow them as they're able to move the market? Yes and no. So yeah, what we're trying to do is we're trying to front run large orders, but I don't think that you can just like spot them and follow, right? Because usually what happens is by the time that you're certain that that's what's happening, it's too late. And then you have to take an earlier signal. And then when you take an earlier signal, the amount of times that it actually ends up being a large order isn't enough to make up for the times that it doesn't, and you lose money. So we have to have other information to let us know that those block orders are going to come through, and then we try and see confirmations of them instead. And that way we can take the trade earlier.
There was an executive order by President Biden to actually.
Why does the Bank of New York do the market operations for the Fed? I don't know. That's just kind of been their role. I guess part of it is because they're there in New York, and especially back in the day, it would have been necessary to be in New York to facilitate that kind of activity. I think it's probably how it started.
Using our currency will endeavor. On the issue of financial stability, I totally concur with my vice president. the Guindos, but I will also point you to the last sentence in the first paragraph of our monetary policy statement. And I know that there's been an abuse of that, but we mean it. We will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to safeguard financial stability. So, have no doubt.
Thank you, President, Vice President. Francesco, we want to give it another try, so please ask your question.
Man, you failed twice.
Then I would give the next question to Klaus
with the technology, huh?
Of ARD Television. Klaus Reiner, please.
You know, we've razzled the journalists that cover the Federal Reserve meetings, and some of them have really upped their game. But the ones for the ECB, they're all kind of still using the laptop webcam. Goldman is leaving Russia.
The problem is sorted out. I will then give the question to Martin Arno.
I'm not shocked, actually. I'm shocked that it's taken them this long. What would they even do there now? Yeah.
Hello, President Lagarde. Can you hear me?
Yes, indeed.
Excellent. My two questions are as follows. Firstly, with the ECB...
Iran called on the United States to drop unacceptable proposals in talks on reviving Tehran's nuclear deal world powers, while Russia demands for guarantees from Washington complicate efforts to close an agreement. Sounds like the Iran deal has run into some roadblocks, yeah.
Impact of the shock from the Russian invasion of Ukraine.
Okay, what is a block order? So a block order can mean a couple of different things within different contexts,
Reaction
right?
If the Ukraine Central Bank was to request a swap line from the ECB. Thank you very much.
So
Thank you for your question.
in Jigsaw, there is a block order detector. And really all that means within Jigsaw is an order that was really large, right? An order that, you know, I have mine set to be like, if it's more than 3,000, it's a market order that's larger than 3,000, then it calls it a block order. And it marks it with a color and in my tape and stuff like that. On the exchange, they have block orders, and on the exchange, a block order ends up being like a large transaction between two parties that is then later reported to the exchange, right? So, you know, you would transact some amount of contracts that would be like way more than you could really do on the market, and you get a good price by doing it with just one party. Right. And then it comes in later, and you can go on the CME website and they have tools that allow you to look through the block trades. Right. And another context where you'll hear the term block order is like the prime brokers, for instance, they'll do block trades for people. So in this instance, what happens is they'll do a block trade with one counterparty, to trade a large amount of an instrument, and then the prime broker will turn around and they will execute that at the market, right? And you do that because the firm, the prime broker, is really good at executing, and you know that they will get you a better price than if you tried to do it yourself. But it's not necessarily a block trade that gets reported on the exchange, right? It's just like it's the traders at Goldman or wherever else it is executing a block order for them. So those are kind of three different contexts in which you might hear the term a block order.
Because we acknowledge the fact that in the present environment, which is that of high inflation and not low inflation, as it was in the past, the support that net asset
I want to do a block trade. I'm okay. I'm okay with staying flat right now.
Is getting close to conclusion, and therefore requires that we decelerate the pace of purchases, consider the fact in Q3, or at the end of Q2 rather, to decide whether, depending on the data that we get, we effectively conclude net asset purchases.
I do not believe that Jigsaw has the features for trading stock at the moment.
Thank you, Madame Lagarde.
You might be able to see some stuff through interactive brokers, but I've never heard anybody doing that. Jigsaw has their own Discord. So you could... Oh, actually, maybe that's only open to members. I don't know. But you can definitely ask them. They have ways to ask them. I think that the only time that I've ever heard of anybody trading stocks with this kind of data was with Bookmap, and it wasn't like a full solution. There was, it was still really rough.
I think it's clear that
Grady has courses on stock trading now.
To the pre-war normal.
Really?
Governments are spending more on defense. Commodity prices are likely to stay higher than before, and the green transition is going to be accelerated. Now, all of these factors are
he hasn't changed his courses.
Is this something that you discussed in the governing council?
Maybe he has a newer version of the course?
Factors taken into account in your projections?
I mean, I know that there's platforms that do have like DOMs. It's just not the same kind of full-featured DOM that you see in Jigsaw, that's all.
Who thought that given the uncertainty that we have, we should be uncertain.
And frankly, Jigsaw would need a couple of features to really work on stocks. Like one of the features that they would need is to be able to aggregate prices, so that I could change the ES so that instead of each price level being a quarter of a point, each price level being a full point, so that you can like zoom in and out.
And supported by the executive board and presented by Philip Lane, the chief economist, was this...
Unless you use Ready. I know that you can do it with Ready, but you basically have to be a hedge fund to be able to use Ready.
Acknowledging the inflation numbers that we are seeing now, and the inflation outlook that we have for the medium term.
Now, so your charts might be able to do it.
A path that reduces net asset purchases, brings us to...
You got another problem though, right? Which is like the wash trading rollover in stocks. So I wouldn't recommend trying to scalp stocks.
We are seeing in the scenarios produced by staff. So that's
could be some opportunities there in the future. It's a place that we should keep an eye on, but it's not something that is really practical as of right now.
The removal of the shortly before, which has not been replaced by shortly after, but by sometimes after, so as to delink, and maximum agility and flexibility, as you will have seen in the description of the various instruments, and that thing that was published in the press release. And I'm here referring clearly to flexibility that we give ourselves under the PEP reinvestment policy. Speaking of reinvestment, let's not forget that we have a five. I just want to.
I think that recession scenarios are on the table, but I'm not certain that we're definitely going to head into a recession. It's just a risk at the moment.
Somewhere.
Certainly seen some concerning things over the past week.
5 trillion euros of assets that we will be reinvesting over the course of time. So it's not as if we were, tightening monetary policy going forward. We are normalizing monetary policy with the caveats that I have just outlined. Now, obviously, when we look at the medium-term inflation outlook, we also do a risk analysis. And while we are clearly of the view that given the drivers behind inflation, energy predominantly for the moment, supply bottlenecks, food prices increases, and a broader increase of prices in general, which is coming from energy predominantly and translates throughout all the items, clearly risks to inflation is to the upside, particularly in the short term, but possibly also in the medium term. but not exclusively, because risk to inflation could also be to the downside. So you mentioned some of the investment projects, some of the fiscal spending that will probably take place over the course of the next few years. And that will certainly continue to push prices up. If anything, it's a good reason that we should stick to our mandate of price stability.
Interesting movement in the dollar this morning.
Inflation outlook to
We'll move that over there.
Thank you.
Thank you, Madame Lagarde. And the next question goes to Mark Scheuers of Börsenzeitung. Mark, please.
Okay, so apparently Lavrov has been speaking and said, we don't plan to attack other countries. We did not attack Ukraine either. Oh, good grief.
No. No, sorry. I will then go to Eric Albert of Le Monde. Eric, please.
It really comes down to the terminology, right, Lucas?
Yes.
Thank you very much for taking my question. I got a couple of questions. One on the fiscal side. As we are talking now,
See, I think that technical analysis should be defined as the philosophy that the market contains all fundamental information is reflected in price. That's what I think we should call technical analysis. And I think that the analysis of market data and patterns should be called quantitative analysis.
This energy shock might be. It looks like, if Europe turns its back to Russian gas and oil, there will be a very long-lasting shock, and it will be for the foreseeable.
I think that's more reflective of how the people that use quant strategies versus TA strategies, I think that's more reflective of how they're basing their strategies. I think it's more reflective of the history of the strategies.
Continue to be critically
important.
What form it takes?
The people that are into technical analysis, they want to call it just, analyzing price. That's all technical analysis. So the people that do technical analysis are going to disagree with that. But I think that it's a way more useful framework for discussion, right?
We'll have to decide, and I'm sure that they are, as we speak, or as
long as we're always pointing out that that's the terminology that we're using.
Long-standing record of arguing for some fiscal facility at the European-wide level in order to respond to shocks. We are clearly facing a major shock, whether it is...
You'll have some spillover from fundamental information in a price?
Or whether it is...
Well, but I think it's just kind of...
facility that we've advocated.
How do I put this?
And do believe that it can be extremely helpful, particularly in order to move Europe to a more integrated...
Once you really understand why the market moves the way that it does, the question about, well, first of all, that the current market price does not reflect all available information, okay? So to what extent does it reflect all available information? At that point, the question doesn't really make any sense, right? Because what we find is that there are orders out there that can move price very, very far away from fundamental value that has absolutely no information whatsoever behind them. So it's kind of pointless to try and determine how much does it actually reflect the fundamental information, because at that point it's just so far off that it's just not useful in terms of trying to find the fundamental information. You essentially cannot do the kind of analysis that people are trying to do without having the data as well, which means like you're going to want to open up a chart and say, here is a move, and this was the piece of information that they were using that caused that move, and then just go in with the understanding that the degree to which they moved and the price that they chose was not necessarily have anything to do with the information, but with the number of people that traded it.
Hi, can you hear me okay?
right?
Yes.
Okay, fantastic. Thanks, President Lagarde. Just 2 quick questions. To what extent was the plan that you put forward
This camera, look, it says this guy in the back isn't blurred.
considered in the current forecast for inflation?
but the rest is.
About a short time after that wording for raising interest rates, are we supposed
There he goes. Now he's gone.
than how it was described before, where asset purchase program would end shortly before interest rates would increase?
I would have to double check on your first question, because I'm not aware that the plan to reduce dependency on Russian gas was incorporated as a geopolitical decision or as an energy decision made by the European authorities and with the national leaders of the member states.
It's pretty funny.
Sure is that we factored in a significant.
I guess another way of putting it would be people believe that the price reflects all available information. It doesn't. And therefore, if all the fundamental information is important, you're just going to have to know the fundamental information.
We could have substituted the short.
Or you're going to have to know it as well as you can, at least.
But that would have made it too time dependent in terms of decision making. We want to be data dependent. So whenever the data confirms that the medium-term inflation outlook is at target.
And see that the Russian propaganda outlets are still pushing these U.S. biolabs stories.
A time element that would predicate that within X weeks or within X months, decision will be made. So the deliberate use of sometime after opens sufficiently wide an
But what is value exactly?
So that we can review the data, determine the robustness of the data, make sure that some uncertainty has cleared a bit, so that we can make a decision. I don't know how I can more explain this sometime after, but that's what our debate was about.
Thank you, President.
And again, if I can just insist on that, we want to have as much optionalities as possible. We recognize
You know what a lot of the Zero Hedge was saying they will stress optionality. And there she is. She's doing it right there.
those circumstances. And to do that, we need to have all optionalities on the table. We keep all the options opened, and we will proceed, and we are proceeding step by step.
The next question is...
Okay, but
Azahara
we should go into more detail on this when they're done here talking in 5 minutes.
Hi, thank you. Can you hear me?
Yes.
Okay, thank you very much. My question is for Vice President De Guindos. Back in 2012, when you were Spain's economy minister and the Sareb was created, you were in a press conference where the Vice President Soraya Sáenz de Santa María said that Sareb would not cost an euro for the taxpayer.
When the cash market is open, what do you expect from bonds?
Minimize the impact that the bank intervention.
I'm not so sure, to be honest with you. I kind of feel like with what we got, I'm not really seeing anything from this press conference that seems too important. Of course, I haven't been very good at paying attention today, have I? But
well, what I have to say is that Sareb was part of the package to rescue the Spanish financial system. And, it was agreed with the European Commission.
And the CPI didn't really give us anything to trade off of either, so...
And, Sareb was perhaps, the most powerful...
You might be really confusing trading in the bonds.
Of the Spanish banks.
We do still have some, let's see here.
It's right, it has a debt of 35 billion euros. But as well now, it has assets worth clearly beyond.
Yeah, that's correct. We do have the 30-year bond auction today.
Sareb, it has been quite a useful instrument that was used as well And this instrument was used in other.
The 30-year has been doing a little better, so we might actually see bonds move up a little bit.
What we have to do is to try to gain time in order to get advantage of the evolution of the real estate in Spain, that now is much more positive, and to reduce as much as possible the level of debt of Sareb.
Thank you, Vice President.
Well, like so many others, I am sickened by Russia's invasion of Ukraine and the gigantic humanitarian crisis it continues to create. At DuckDuckGo, we've been rolling out search updates that downrank sites associated with Russian disinformation. That kind of undermines the whole thing of DuckDuckGo, doesn't it? Okay. So now that I can think clearly and we don't have the UCB in the background. According to Google, the regard that something is held to deserve the importance, worth, or usefulness of something. So, if we're to apply that to price, I am saying that there is no price that holds in the importance, worth, or usefulness of something other than ones that perhaps have been embedded in the people's psyches so strongly that they do have an impact on the markets, although the impact that they're going to have on the markets can be very difficult to predict. But the kinds of levels that tend to do that sort of thing are going to be daily highs and lows, 50, 100, 200-day moving averages, and daily VWAP. Okay, are the kinds of the price levels that appear to have the most impact in the market. But again, they're not predictive. Like, you can't come in and say it crossed this price level, and so now that means that X thing is going to happen, right? I think your question is then how to calculate value, not what value is. Well, okay, so here's how I would approach it, okay? There is a price that is the accurate fundamental value of an asset based on future earnings or the future performance of the instrument or whatever the deal is, right? Okay, so for a treasury, if we know for a 10-year treasury, if we were able to see in the future and knew what the interest rates for the 10-year treasury will be 10 years from now, then we would be able to calculate the true fundamental value of a treasury, right? And we would know what that. So there is a theoretical number, right? But it is not a practical number because we can't calculate that. We don't have the future information, right? And there are all sorts of ways to try and estimate what that may actually be, but they're all imprecise and have issues, right? But that would be fundamental value. So what you can do is you can go and you can have your models that try and calculate what fundamental value is, but you just have to understand that the market is not fundamentally efficient. So which means that there's absolutely no obligation by the market to respect your fundamental price at all. They can move very, very far beyond what your fundamental price is, and they can stay at those elevated levels for an extremely long time, right? So this is like my approach in Bitcoin, right? I have an indicator that based on how much money is being transacted through the blockchain, I try to estimate what Bitcoin is worth. And we find that when they get too far away from that value level or too far below that value level, we tend to have peaks, highs and lows. But they can stay elevated there for a long time, 4 years, right? And now why is that? Because orders are what moves the price. So for you as a trader, what is the thing that you should be really looking at? I mean, is having all of the fundamental information important? It absolutely is, okay? But why is that information useful? Because you can use it to predict future orders. Because in the end, for you as trading, all that matters is the future orders. If you take a position, are the future orders in your favor or not in your favor? And everything that you have to do basically comes down to predicting those future orders. Sometimes we can run into situations where we will get a piece of information before everybody else that has a very, very high possibility of predicting what the future orders are going to be. And that's where we can make money. If you estimated a set value and it moves too far away during a longer period of time than what you estimated, then your estimation of, well, no, it's not. I'd say that the market's price can be wrong. Like, the market can come in and they can say that, Tesla should trade X times future earnings. That doesn't mean that 5 years from now that they're actually going to be getting those earnings and that the people in that stock will be rewarded for it, right? The current market price does not reflect the fundamental value of the asset, right? See, here's what I'm kind of detecting, and I totally understand it, is we want to believe that the current price that we're seeing on here means something, right? Because if it doesn't mean anything, then like, what are we doing? Right? The whole point of this system is to be able to give us an effective price that we can trade off of, right? Wrong. The entire point of the system is to facilitate the transactions. That's it. And the price at which the transactions go through, that's 100% up to you which price you decide to execute them at. So it's contingent on you that you buy and sell things at good prices, right? Everybody can have their own version of trying to determine what that price should be worth. But in the end, who am I to come in and say this price is too high and this price is too low? It's not my place. You can't do that without limiting freedoms, right? And once you start to limit freedoms, then you take away people's incentives to participate in the system. And that's why all of these other systems that don't have free enterprise fail. You have to have the free enterprise component in order to get people to participate and in order for things to move, right? But we were sold a fantasy that the prices that the market was giving us were fair prices. They're not. They're objectively not. The market maker, what the market maker puts out there, the reason that they're selecting the bids and offers that they are is because they, based on the information that they have, those are good prices for them and not good prices for anybody trading against them, right? Well, I'm talking about a single instrument without considering the entire market and their correlations. Well, I don't know why correlations really factors into that. The larger picture is that you just got to understand the price that we have. It has absolutely nothing to do with what it's really worth. It has absolutely nothing to do with all available information factored in. It has nothing to do with it. It is only a reflection of the orders that were placed into the instrument. That's it. That's it. Only a reflection of the orders. When you understand that it's only a reflection of the orders, then all of these other fallacies that people try and base their strategies off of go away, and you wouldn't even consider using those strategies, right? When you come into that framework, there's only one way to make money: predict the future orders. Because what fundamental value is? It doesn't matter. It only matters in as much as it may be able to predict future orders, right? Hey, Sager, welcome back. It's only useful in as much as it can help us predict future orders, right? So what should we be spending our time on? We should be spending our time on things that are effective at predicting that future orders are going to come through. No, it doesn't matter. Not to us in terms of making money from day trading, right? The fundamental value only matters, and let's say, first of all, we don't have fundamental value. Nobody does. It's a theoretical concept. But your estimation of fundamental value doesn't matter. It only matters in as much as you may be able to use it to predict future orders, right? Because there can be a situation where you have a fundamental value, like let's say oil, you have some way of calculating what the price of oil should be based on global supply and demand, right? But then, and it says that the price of oil should be below $100. But then you hear over the news squawk that the Russians just detonated an atomic bomb. Then guess what? Oil is going to go up. And it doesn't matter what your estimation of fundamental value was. And it doesn't matter if that particular event changes anything in your estimation of fundamental value, right? All that matters is what? The orders that get placed into the instrument at that point. The sum of all those orders, all of the limit orders, all of the market orders, all of the limit orders canceling, that's what's going to determine the price. And for you to make money, you have to predict what those orders are going to do. If you make money, it's because you came in and you bought it, and then there were orders after you that also bought it in such a manner in which it moved price up. By fundamental value, I mean, you mean something. I mean, you have some calculation that tells you that a certain price is significant or more fair than others, right? And sure, it changes all the time. But again, that doesn't mean that the market has to respect it, right? But that's the kind of larger overarching point here is that we try to give this special importance to certain prices. And why do we want to do that? Well, we want to do that because that's what we deal with. That's what we deal with is price, right? So, of course, some prices have to matter more than others. And our natural tendency is look for patterns in price and see if I can predict future price, right? But what we've learned through the research is that that doesn't work very well, right? And why doesn't that work very well? Because what moves the market isn't the price itself, it's the orders. The orders are what determines what the price is. And those orders, according to our research, the market is inelastic, which means that those orders, the future orders have very little to do with what the current price is. The amount of future orders that come through has very little to do with what the future price is, right? That's what the research tells us. So why should we put all of this importance on certain prices? The only time that it matters is if we have something to tell us that a certain price or the market doing a certain thing at a certain price or whatever the deal is, it has a high probability of predicting the future orders, right? And I just, from everything that I've done, tends not to do that. The market certainly will react to certain prices, but the end result of that reaction and how it will really behave after that on, a 5-minute time frame, difficult to predict. There's not any real consistent pattern to it that I can decipher. You say orders are what moves the markets, but as traders, we look for the intention behind those orders. Why are they coming in at certain prices and how are they coming? Well, no, this is not, but it's I want to know why the orders are coming through, because I want to know if there's going to be more orders, right? So why does it matter? So if we have an order that comes through and it's because the CPI was too low or was in line. Okay, so CPI was in line, so we've had some orders buying, right? And then there's a 30-year auction. So maybe there's some orders that are coming through and they're selling because of the 30-year auction. That's a scenario that we're kind of looking for right now, right? So why do we care? Why do we care? Because those are the two most dominant factors in the market right now. And there might be more people buying because the CPI was in line, and there might be more people selling in the future. That is, there might be people that sell in the future because of the 30-year auction. And there might be people that buy in the future because of the 30-year auction after the auction, right? And so the only reason that we care about what's moving the market is because it could be a part of a large meta order, and there might be more of that order. And then we can predict those future orders, right? The rest of that meta order, essentially, right? That's why I can come in and I can say, okay, there's CPI. If CPI is in line, here are the number of orders out in the market that I estimate will have to react to that. When that happens, it's usually like 0, but hey, how many orders are going to have to react to that piece of information? And then I can see, okay, if that happened, there's probably going to be like 60,000 contracts net buy, right? And then I've only seen 1,000 come through, but I saw 1,000 come through in a way that suggests to me that somebody really is going to be buying 60,000 contracts. Yep. As I predicted, it's in line with my prediction. Then I take the trade. Why? Because I have a piece of information that I believe has a high probability of predicting the future orders. So why does the intention behind those orders matter? Because we might be able to use that information to predict the future orders, right? But you got to understand that sometimes the thing is, it's the end of the month. And people tend to buy treasuries at the end of the month because they have to build up their inventory for all of their operations that they do throughout the month. So is there fundamental information involved in that? It doesn't tell you anything about the economy, right? You come back over onto the chart over here in the treasury, and we go back to, I guess I have to go to a daily chart. And I go back to, December up and through here, and there was people that were buying the treasury going, from the beginning of the month to mid-month. They're buying, and we can come in and we can say, okay, why are they buying? The technical analysis, sorry, I'm not showing you the chart here, okay? The technical analysis approach here would be, okay, higher low, higher high, that's bullish. This reflects that the market participants know something. Maybe the thing that they know is that the Federal Reserve isn't actually going to raise rates. And that's where you get so many people that argued with me for so long, the Federal Reserve's not going to taper. The Federal Reserve's not going to raise rates. Yada, 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 yada. What was really going on here? They're buying because they needed the capital and stuff. They were buying because they needed collateral for operations and stuff. And guess what? As soon as the year turned and you get to the point where there's a lot of rebalancing of treasuries and stuff, they sold it super hard. Guess what? This right here, we knew that was going to happen. I didn't think that it was going to happen so fast, and so I kind of missed most of it. Right? I didn't think that it was going to happen in that way, but I could have pretty much told you probably interest rates are going to rise in January, right? Market wasn't pricing that in. Market was pricing in the exact opposite thing. Why? Because that orders are what matters, and the orders that were being placed in here because of the situation and what they had to be doing at that moment, they were going up. And then when we came over here, because of what they were doing at this moment, it went down, and it didn't have any correlation to what we knew at the time, did it? Right? So the technical analysis approach to things completely failed people in this situation and caused a large number of retail traders to just get it completely wrong and miss, if it wasn't for Ukraine, the biggest story of the year here with the interest rates rising, right? Meanwhile, I'm sitting over here short from December and rode that whole thing and made 10%. Well, on a sim account, but you get what I'm saying, right? I'm just trying to prove to you, right? Market doesn't reflect all fundamental information. It's just nonsense to even try to approach the market from that direction, right? Predicting future orders from existing orders, does that mean it's trend following strategy or momentum strategy works and mean reversion doesn't? No, because the current orders on their own are from my okay, so there are a few empirical properties about markets that we can pick up from based on current orders, right? In particular, there is a large degree of autocorrelation in the sign of the orders, which means that if I see a buy right now, there's a 0.5% chance. If I see a buy order now, there's a 0.5% chance that exactly 1 hour from now, the order that I see exactly 1 hour from now will also be a buy. Okay? 0.5% chance. Think about that now. Think about how much that is. It's like, that's actually a really strong degree of correlation. But in terms of like the statistical properties of it being able to tell you, okay, so that means that if I buy, that I'm going to get, that it's going to go up. Nah, it's not enough for you to make money off of, right? So there are some things that we can predict about future orders from current orders, but it's not enough, right? But that doesn't mean that it's not a part of the larger picture, right? We can look at what the current orders are. We can look at the information that we know. We can look at certain tendencies that we can see in how, by knowing how the funds work and how they do their business and how they rebalance things and stuff like that. And we can take this big long list of possible predictors of order flow, and we can use that to be able to predict the order flow on its own, right? And if you only have just one piece of that, so if you only have the orders or if you only have the information, it's kind of hard to pull something out. But when you have all of those things together, there are some edge cases where we as retail traders are able to get our hands on enough information to be able to make profitable trades. When you say that market doesn't reflect value, you're only talking about a single instrument. You can't make those sorts of analyses in isolation. Well, so if any one single instrument is not equal to value most of the time, then that just messes the whole system up anyways, right? None of these instruments are going to reflect fundamental value. None of them do. They only reflect the orders that are being placed into them. Yeah, the markets definitely use correlations, right? A market maker can come in and watch the 6J and the 10-year treasury and all of the other treasuries and the dollar and the S&P 500 and the correlations between those to determine a fair price that, if the dollar moves, then I want to move my bids and offers here and that sort of a thing, right? And they can make money off of the correlations, but again, that doesn't mean that the instrument reflects fundamental value, right? And if the 10-year treasury moves up, like that's the thing is the 10-year treasury could move up and that could cause a move in the 6J and that could move the 6J away from its fundamental value, right? You need to understand that the value is a relative concept. Well, but it doesn't matter how you choose. Like that's the thing. It doesn't matter how you're picking it, right? The market doesn't have to respect it. It's just there is never a situation. I'm just telling you what we see from the evidence is that there is not this situation where I can say, here's the price. This is what the price is going to be in 5 minutes. It doesn't work that way. The way that the market works basically makes that kind of prediction silly. What do you mean when you say that the market doesn't have to respect something? I mean that you can have a price that you think is important, and a big block order is going to come in and move it another way. And it's so like here's why so here's an approach. This is the approach that I think you're taking. Okay, correct me if I'm wrong. But you're probably doing something similar to auction theory, right? You're saying there's this price right here, 126.09 that had a lot of volume traded at it. That means that price is fundamental value. So I think that because there's no information in the market and everything, that price is just going to rotate around my fundamental value. So I want to buy 07.5 and I want to sell 126.12. And that's how I'm going to derive my edge, is because I know where value is and how far away from value they can get. And, what's going to happen is a block order can be completely random, will come and move us down way, way, way further than you can possibly expect. And the amount of times that is going to happen is going to be so high that you're going to, there's no real statistical reason to actually think that there's anything important about this price at all. Because you can't just, there is no known way of selecting a price or even looking at the history of a price and effectively predicting what the price is going to do in the future. So ignore that. Ignore that. Here's the approach. What are the future orders going to be? Do I know something that will predict future orders? It doesn't matter what the price is at that point. The only thing that matters is that the orders are going to come and it's going to move it. Right? Now, there is one thing that you can look at that matters, and that is what is the current liquidity condition. That's another piece of the puzzle, right? I need to have predictors of order flow. I need to have what my current order flow is. Part of what that current order flow is what are the liquidity conditions, right? Those are anomalies? So no, they're not anomalies. The frequency with which it happens is so high that like that's the thing, is that there are block orders coming through every day that have no informational content whatsoever and can move price. No, it has nothing to do with it working 100% of the time, Lucas. The result that you're going to get is random. There's no positive expectancy on it. Okay, so as you see an instrument approach a low for the session, what order flow indicators do you look at to predict a reversal or a breaking a low? Okay, so here's what I would say about if you're looking at lows and highs, right? Okay, the general way of doing things is that if a significant high or low is broken, that it will continue through, right? Or rather, that is what people believe, and that is how people tend to trade it, right? But again, what's going to ultimately predict what's going to happen? What are the orders, right? So we could use the situational context to look at a bunch of other things to maybe try and predict what might happen in that kind of situation, right? We're approaching yesterday's low, and the market sentiment is poor because of, there's been more drama in Ukraine. Market sentiment is low. Then, yeah, probably probably you can sell into that low and it's going to go lower because you can just know what are the orders going to be today. They're going to be sells because the market sentiment is bad, right? If you're a bad scalper and your estimation of value is constantly wrong, you'll get random results at best. But I'm saying that anybody that ever tried to do that in the history of ever, they were getting random results. Alligator says this market doesn't know what it wants. What are you, God, to know that? Well, the reason why I can say that is because we have empirical evidence that suggests that's the case. Think about it. If there was a way, if there is a way of estimating value that is effective at producing a certain positive expectancy, then everybody would know about it. And everybody would just use that. Right? This whole concept that you can see a pattern in the data and you can just trade that pattern in the data and make money from it is a mirage, guys. The way that the market works explicitly makes that sort of a thing not work. Because if you find something that really has a positive expectancy, you're going to trade it, you're going to size up, and you're going to size up until that inefficiency is gone from the market. Excuse me, right? Listen to the buyer and seller instead of a lot of clever. And it's just, I'm telling you, look, if you go to Wall Street and you go and work for a prime dealer or a hedge fund or something like that, I'm telling you, they don't look at this shit. They don't care that it was a higher high or a higher low. That's not effective at predicting the future price. It's not. We could go through the data like 1 trillion times. I can backtest it like 100 different ways that it goes there. I don't understand. Why is it that like everybody just wants to believe that it's there? It's like, okay, yeah, like you've been digging for 5 years, you haven't find it. What makes you think that you dig for another year, you're going to find it? Right? And then here I am sitting here saying, look, here is like the empirical behavior of the market. Okay. Markets, because of the way that they work, are informationally inefficient and relatively statistically efficient. Okay. So if you see a pattern in there, market arbitrages that out really well. But if you have a piece of information that says it should be worth X, market tends not to be that value. And if you have a piece of news comes out that says that it should be worth Y now, it tends to be not go far enough or to go too far. Why? Because the market doesn't reflect all fundamental information, right? So we have all of that, and we have a way. Okay, so if we want to be profitable at trading, we need to predict the future orders. The future orders is not really going to have anything to do with the current price. We might be able to factor the current price and the current order flow into our equation, but ultimately we're going to also need to have outside information that is effective at predicting those future orders to do it, right? But then people still want to turn around and say, oh, okay, I still think that if you were just smarter and you were to do things just the right way, that you're going to go and find the correct combination of things that actually proves that wrong. When it's like people have been searching for 100 years to find that and haven't found it. You know what I mean? So I don't understand where the disconnect is in there. I don't understand why this mirage that you're chasing is so appealing to you, whereas everything that we know about the empirical properties of the markets and how you should trade based off of that isn't appealing. Why is this so? I don't get it. It makes absolutely zero sense to me. And I come in here and I have this discussion with you guys every freaking day. You know what? Backtest a million shots and then conclude that you can't successfully play tennis and be good at it with the ball and hit random spots in the court. Okay, but you're ignoring the two counterpoints that I've already made to that argument. Number one, millions of people. I don't know. Maybe I don't know how many people have done it, but let's say it's on the orders of millions of people have been trying for hundreds of years to backtest this and find this particular situation that you're talking about, and they don't find it. Okay, there are some things on very, very short time frames, right? There are some things that people arbitrage out of the market, like what Renaissance Technologies does, right? But there's not something that is like fundamental to the market that you can always trade in and you make money off of it, right? It doesn't work that way. Okay. People are looking for it. They haven't found it. They haven't found it. So that's the first counter. And the second counter is that we have empirical evidence that suggests that that's not going to work anyways. Right? So it would be one thing. It's like, okay, you say that the market is not informationally efficient. But guess what? I went and I found this thing and that says that it is. I found this way where I can take this equation and this factor of things and I can always correctly predict what the right price is going to be. And if the market is away from that right price, it moves back to the correct price very quickly. Right? And then you would be able to present that as information that, hey, guess what? Actually, the market is pretty informationally efficient. Right? But that's not what you're saying. You're saying, well, you just need to look harder and maybe you'll find that. You know what I mean? And then the whole question is just like, forget about how good you are at it or how good I am at backtesting it. And I think that I'm pretty good at it. But what makes you think you can find it? What piece of information do you have that makes you think that that is more worth your time than the research that we already have? What? I don't get it. Think about it. This is dead serious, guys. How much time have you spent in your life looking for these things and you have not found it? And if it doesn't exist, what does that mean? It means that all of that effort was a waste because you were just looking in the wrong spot. You can dig a hole and you can go as deep as you want. It doesn't necessarily mean you can find gold, right? And then here I'm turning around and I'm saying, look, hey guys, there's this research out there. They found that when you find iron, there's more likely to be gold in that area. So we should go and try and dig in places where there's iron. And you still want to go and dig over here where you've been digging for 10 years and you didn't find anything. I don't get it. I don't get it. I think you're purposely looking only at Feld's cases and ignoring people who came forward. I'm not actually. It's just that, number one, I've literally never seen anybody give me a 5-year record showing profitability. And then if there was a situation like that, then we would have to ask two questions. Number one, we'd have to look at the data and we'd have to say, are their results better than random? Are their results actually good on a risk-adjusted basis? Right? And then we would also have to ask, is their method really actually technical, or are they actually doing what I'm saying to do? Right? And that's the funny thing about it, is that these people that are, this mythical person that is successful that we haven't talked to, right? They might be doing exactly what I'm saying and not realize it. Right? But then this is a fair case. Is like, okay, So I'm saying you've been digging here for a long time. You haven't found any gold. You're saying that Bob found gold there one time, is what you're saying, right? Who's Bob? Tell me about Bob here. What was it that he found? What evidence do we have of that he actually found gold? Have you seen the gold that he found? How big of a piece of the gold was it? Are you sure that he just didn't bring it from somewhere else? Are you sure that the amount of gold that he found, he didn't actually find it from just like, you know, he had a huge machine that you can't afford, you know? Right? It's just like, why dig there? Why dig there? Because Bob found something there? First you got to prove to me that Bob found something there. Because here's the thing. If you go to Wall Street, you know what they're going to teach you? They're going to teach you this stuff that I'm telling you. They're going to teach you that all orders have impact. The markets are not efficient. They're definitely not fundamentally efficient. They're not informationally fundamentally efficient. They're going to tell you that markets are inelastic. You know why? Because they take this research and then they extend it. And they go further. They're going to tell you about the square root law of meta order impact. They're going to teach you about how moves leave wakes behind them that can make it easier for price to reverse back down on itself. Right? Oh, you got a big order in the. Ooh, wow. Yeah, that is weird. That is really weird. But you know what? There's also one in the 5 years. So is somebody doing a 10 and 5? Well, but they're both bids. Where would the offer be? Is there an offer in the 2 year? I don't pull the 2 year up very often, but that's a big enough one in a very unusual situation that I think I want to go and look. No, I don't see anything there. Very interesting. Well, there's nothing really significant about that's not like round numbers that they're putting them out or anything. I don't see anything else going on in the market. It kind of seems like that the market seems a little directionless right now. Like people want to trade, but they don't really have any good reason, anything to drive the trade. So I do think that the trend has been down in the treasuries and that we are likely to see the treasuries continue to move down. But overall, I find that particular order very suspicious. But even when I share it, you say, well, he probably doing what you say you must do, despite clearly stating that he uses TA. Well, listen, I wouldn't trust what an individual person says. You would have to look through their actual trading stats and see how they actually traded, right? Because my observation has been every time that I've found somebody that's made a little bit of money doing this, and I've never found somebody that's done 5 years, but every person that I've talked to, they didn't really actually understand what they were doing. There was things that I could see that they were doing that they were pulling edge out of that they didn't realize themselves. Usually taking on a lot of risk, actually, right? So that's why you can't just say, hey, Bob said that he made money and that he used technical analysis, right? So like what like I really think that this analogy that I'm using here is like super, super apt. Is people are saying that you can use 2 sticks to find where gold is, and I'm saying, hey, why don't you go and look for iron? Because if you find iron, there's more likely to be gold in that area, right? Because that's what the science and the research says. And you know what? There's this big company that they mine for gold and they make a lot of money. And where do they mine for their gold? Where they found the iron. And that's how the company works. And then I'm saying this is all of the information that I learned from just looking at what the company works and kind of learning the science that most retail traders never look at. Okay. And everybody still insists on using the sticks because Bob said that he used the sticks, I guess. But first we have to know who Bob is. Right? And yes, I probably will destroy them. You know why? Because he probably isn't really actually using TA totally. And he probably like that's just the thing that's so crazy about it is like the probability is he's lying, he was taking on excessive risk, or he was lucky. I say 5 years because then the 5 years pretty difficult to be lucky for 5 years. What good does any evidence that I bring do? Well, that's kind of what I'm asking, right? Is because I'm not so sure that you understand what evidence would be required to be disprove the theory. You think that it's an option role? That could be. I mean, we have continued to move down. But do you see here in the micros? Oh, no, wait, that's the ZT. I was going to say that doesn't look to me, well, I mean, we've traded a range here for today, but that doesn't seem to me that the yields are actually moving all that much. But we have the best indicator ever. We have some, I have to say that this little model that we built that tries to show where market makers positioning is, it sure seems to be effective at, if there is like an event that really changes the market and like causes the market makers to just dump everything that they have, it seems to go to that line like every freaking time. I don't know how I can go about improving that. Like, it seems like this is something that we could write a study about, but I don't have the resources to truly study it, because I would have to be able to go through and say every time that something like this has happened, and did it go to my line and stuff, you know? And I don't know how you can identify those spots. I would have to do it by hand. I would have to be going through the charts and, okay, here's a move. Oh yeah, that was based off of this. Yeah, I went over to here, you know? How do you define your data set? I am arguing on ways to calculate value, but the whole point, and again, is that the value is useless to you unless it can predict future orders, right? And what do we find? Current prices don't predict future orders very well. Surely there is a theoretical fundamental value, yes. I think, you know, like here in the Treasury, I'm pretty sure that you can come in and say, here's what the interest rates are going to be based on what the Federal Reserve has said. And here's what like the correct prices are based off of that, or like the range of prices. You can do that. Yeah, for sure. But we would still want to go through and say, you know, do a study of it and say, okay, based on that, how effective is that strategy, right? But we've already gone, what I just said there kind of already went outside of the scope, right? Because I'm using information outside of just what the market says, right? Because I know what the Federal Reserve has said about how many interest rate raises there's going to be, right? So that we were already beyond a purely technical strategy. How many positions do you have per day? You know, I've been trying to keep it to around 4, under 4. I've been trading a lot less as of late because the Ukrainian volatility has just really made it too messy for me to trade. Well, they were really pushing the downside there on the treasury, and they've backed off for now. I also never said that you can calculate value out of current price alone. Well, but if you're using something else, if you're using something other than price and volume, then you're now admitting the point, right? Market's not fundamentally efficient. You would have to have information from outside of the market to calculate what theoretical fundamental value is. You need a comprehension of context. Yeah, context is too vague of a word. We can't use context in the. I don't think we should use the word context in this argument, right? Because I don't know if all those other things that you mentioned are all things that you would need to factor into your analysis. Yeah, correlations, liquidity, volume, volatility. You already orders coming through. Let's not say volume. Let's just say the orders, right? Correlations, the orders, and the volatility are all important factors, right? Now you say context. Is context information from outside of the market or from outside of the exchange, really? Or is context like how close we are to the daily high and low, right? Because I could say, it seems to me how close we are to daily and previous day highs and lows, VWAP, and 50, 100, 200 day moving averages does appear to be something that you could maybe factor into your analysis, right? But when I think context, I'm thinking context is like, what's the sentiment today? What were the pieces of news that are moving things? I think that when John Grady says context, I think that those are things that are included in it, right? Because really what the word context means is there's a lot of other information that we have to be able to use to be able to make our decisions, and I can't necessarily enumerate what they all are. That's really what context means, right? So it would behoove us to start to specify what is included in context, right? Those, the more money you use, the bigger time frame it should be how it works. Well, I think your question is the larger your time frame is, the larger size you can trade. Yes. Because there does become a point where your size is too big that you can't do the small trades. You'll lose money if you try and do it, the small trade. You use too many contracts, you move it, and then when you sell, the impact of your market of your orders will be too much, and you'll net lose money. What was the price that they were giving me? 2.008 maybe? My puppy seems to like the lights that I use to light the corner up. And I'm worried that he's going to be looking into the light and hurt his eyes. Context is understanding that it might be harder to fade to treasuries when it's behaving like a steamroller and we have a one-way market. Well, so you're saying that context is the degree of trend? Okay. It's understanding the grid might be more, but so now you're using a piece of information from outside of the exchange, right? So now, so that's, you've just explicitly stated context includes non-quantitative information, right? Saying context includes non-quantitative information. I'm thinking here, well, there's this big order at 01. At the moment, it kind of feels like that they're going to try and go for it at some point. Given the trend and everything else, it's certainly within the range of possibilities. And 126 even was kind of been a key price that they've been looking at for a long time. I don't know why they have it 2 ticks above 126. It's kind of weird. But the thing that I'm asking myself, though, is this the price that they're giving me in the micro yields? You know, can I really take 01.5 and get something from that? And I'm not sure that trade really makes sense for me, especially given the time that we have. You know, I really hate trying to enter a trade at 8:30. I do feel like it is going to go, though. No, you're using this information to look at oil more. Okay, so what would be the quote unquote context that would let you know that you have to look at oil more? So you're weighting a certain part of your system based on what conditions? Hold on. Seriously, bro, this night is You can say Bitcoin is an easy short yesterday and it's an easy long today. You know, I don't think that I would have been confident enough in it yesterday that I would have shorted it, but I was certainly very skeptical of the boost that they had yesterday. Now that it's kind of come back, though, I'm just kind of like, who cares? I don't know if I can make any kind of prediction about what it's going to do next. Russian sanctions, so that's non-exchange information, right? No, Biden is speaking at the moment. Oh, you know what? I'd never turned the squawk back on after the ECB. Okay, well, they went the 30 years started moving there a little bit more, so now we could have taken 01.5 and maybe it would have worked out.
BCF forecast minus 100.
Although we have to get 02.5 for it to have justified the trade. Yeah, the one on ZF got filled. The other thing is now we're so close. Let's just see what that happens at 01. But you are. Yeah, okay. You have a function. One of the inputs into your function is a piece of news. Right? Without that piece of news, you can't do the trade. Because what I'm saying is, if you have a function and the inputs to your function are today's price and today's volume and yesterday's price and volume, yesterday's volume, right? That's not enough to be profitable. That's what I'm saying. Buy American oil. There you go. I don't know if buying oil right now really makes sense. Even today hasn't done very well, is it? I think there's a point at which maybe I want to buy oil, but I kind of feel like that we missed the good trade in oil. And now the risk reward doesn't really make much sense. Especially when you look at the option prices, right, are pretty awful. They're in oil. They came awfully close, but they already backed off from that order. And they're already below our own 1/2 as well. No, I am saying,
Majority
okay,
Leader
so
currently speaking on the Senate floor says we hope to pass the government funding.
so let me just confirm if we came to a new point at that right there. You are saying we have a function. One of the inputs into your function is, yes, it is news. Okay. And price and volume on all of those things are involved too. You're saying that, right? You are now further saying that inside this box, part of my function inside of this box is a calculation that uses all of this information to pick a price. And then I buy or sell based on whether we are above or below that price. Right? And here's why I'm saying, if that is the case, here's why I'm saying a strategy like that doesn't work very well. Because you will get a change in this input right here, the news. Can be not only the news, there's another input in here, which is meta orders, okay? Right? And you will get a change in these that will change the output of your function so much that you won't be able to make money from it. You won't be able to execute efficiently enough for that strategy to work. Right? You'll be coming in here and you'll say, here's fundamental value. And then a nuclear bomb goes off and, its fundamental value is way over here and I was short. Oops. I just lost a ton.
24 billion minus
Right.
124 billion. That's a draw on the forecast of minus 119 billion.
So what does it mean? It means that trying to rely on a certain price is kind of, because the future orders,
downside movement.
The future orders always matter more. Not that you can't look at, like I said, I think that trying to calculate what fundamental value should be is a useful thing. It looks like it looks like a Chinese symbol or something to me. I don't think that you can consider it. So they matter orders work through various prices. Those are not anomalies, and you can't account for that. You would like to be able to account for that, but in practicality, we can't, right?
And the US EIA natural gas weekly storage report is now available.
You shouldn't be hearing him. like that's where the what is the word? That is the weakness of the strategy, right? The real weakness of our strategy. Like, here's the thing. I'd say I'm pretty good at the news. I'd say that I know the news early enough and how to interpret it well enough that I can, generally speaking, make money off of the news. Yeah, sometimes that really catches me off guard, but most of the time lately when that's been happening, it just means I don't really take a trade, or I only lose a little bit. I don't know. It's a problem. But the meta orders, man, the ability for me to predict those meta orders, a lot of them are random. A lot of them I don't understand what they come through. It's kind of hard. And your ability to be successful doing this is really dependent on how much of those meta orders you actually know about, unless you're just really, really good at knowing when you know about a meta order and that it's safe for you to trade it and stuff, you know? That's the weakness of the strategy, right? But second of all, you cannot just discount anomalies, because we know that the market has fat tails, which means that thing that you're calling an anomaly could be equal to everything that you've ever made from everything else. So you can't just call it an anomaly. You have to be able to factor those in too. Not, you can't treat all instruments as if they're the same. What instrument are you talking about? Well, do you know of an instrument where you think you know about all of the meta orders that are going to come through? I mean, ZN is one, but obviously, I think it was kind of assumed, or at least we were on the same page, that the factors that you're going to account for are going to change based on the instrument that you're trading. Yes. Yeah, we don't need to know all meta orders. We just have to avoid enough of the ones that we don't know about that we're still make money, right? Right. Like, it has to be a situation where we know that a meta order is coming, and we know that the probability of something else coming in and screwing up our strategy is relatively low. So you come in here, you blind yourself with the light, and then you get bored and you start whining again, huh? Can you guys hear him in the background? No, I'm not sure I can say that you can obviously avoid them in NQ. I think that the meta orders are harder to predict in the equity indexes than in the treasury. Otherwise, equity indexes wouldn't be nearly so random. I mean, like, there's a certain amount of randomness that you should expect just because it's an index and you have all of the stocks, but then really is just like these moves that are just like really bizarre, you know, in the ES. Especially around the open. But that's not something that I can empirically prove. I'm not sure if that is something that you can empirically prove. I could only say that meta orders are a significant factor in all markets, and that it's going to be incredibly difficult for you to know about all of it as a retail trader, just as a matter of practicality. But I think that was kind of a little bit far off from the point. I'm only saying that news, these sorts of things that can move the markets, they create lots of orders, and they happen frequently enough that whatever your fundamental value, like, that's just what the data is, right? Okay, like, the amount, so it comes back to really where we should start is the excess volatility puzzle, right? If we have information, when a new piece of information comes out, we should see the market move based off of that new piece of information and then not go anywhere. And what do we find? That's not the case, obviously. Obviously, that's not the case. Markets are much more volatile The frequency of changes in price are much orders of magnitude higher than the frequency of changes in fundamentals. Okay, we know that. So then we have to admit that there are irrational actors in the market that are trading not just based off of the fundamental information. Okay, right? So then we have to go in and say, okay, what are those impacts? We know that all orders have impact. So what are the impact of those orders? And what we come in and we find is that there are very, very large orders that have no kind of informational content behind them at all. And they move price completely away from where the information should say that they would be. Or maybe they do, or maybe they don't. It doesn't really matter, because the person that's trading it, he's not thinking about the information. He's just thinking about that's what they have to do because they're a fund, right? Yeah, I talk about many subjects at once, and I can only answer about one. Yeah, well, because I know that you're friendly, and I know that you agree with the idea that, or to some extent, that you do have to follow the news, right? But what the larger point that I'm trying to prove to people is that you can't just watch the market price and make all of your decisions off of that. Doesn't work. And understanding why that doesn't work is a very important part of understanding where things are going to go, of actually predicting where things are going to go, right? Because once you understand the impact that orders have on price, and like that's the thing that I really think is kind of like the crux of the issue in reality, or rather the thing that retail trades. Because like here's the thing, I think a really large portion of retail traders are going to say, yeah, markets aren't efficient. They might not be able to differentiate it between like statistical efficiency and informational efficiency and all of that sort of thing. But I think most people, if they really believed that the market was perfectly efficient, they wouldn't trade, right? So I think that most retail traders will agree with us on at least that point, right? But the thing that they don't understand that seems to result in the most wrong understandings about what the market should and shouldn't do, or will be prone or not prone to do, is the impact that the orders actually have. They think that in order to really move the market, you have to be just absolutely massive, and like it like doesn't really happen except for like Goldman Sachs when they're really doing a big order or something. Like that's what people think, right? And the reality is that every order has an impact. And if you were to, when you start going into actually measuring and calculating that impact, it's 5 times higher than what people think it's going to be. And it's high enough that, yeah, you as an individual retail trader are unlikely to be able to get big enough to have that impact unless you're like the top 1% of retail traders. But the combination of all of you trading together absolutely does. In fact, I think that the thing that we really proved with the whole GameStop thing is that the impact that the retail traders can have when they all focus on one thing will overwhelm any other factor in the market. If the larger public catches wind of something and is trading something, that is the biggest force there can be in the markets, right? It's like a GameStop situation. So yeah, we do have an impact. So now that you understand that we have an impact, now all of a sudden the things that the market actually does tend to do make a little bit more sense. Okay, if we have a move up and it's really quick, we're likely to come back down. And if we have an order that's of equal size, we're going to go lower. Now that's something you can use. Unfortunately, it's not a technical pattern like, okay, when you see X, you take this here and you have some expectancy. No, doesn't tell you that, right? But if you know that there's going to be a large meta order buy and there's, well, actually, the situation that you get is we had a big move up here and then you see something, piece of information that tells you that we're going to go back the other way. Like usually it's a piece of breaking news that's like contrary to what everything that's going on, right? You can be pretty confident at that point that you're going to move lower, right? You can use that for sure. And that's something that retail traders don't understand. And those are right down the alley of the kind of thing that retail traders want to know and they don't know, right? It's the same thing with the legs, right? If you're going to execute, because of the way that the order book works and everything, it doesn't make sense for you to just buy it all in one big gulp because you create this liquidity hole. You want to come in and kind of use the liquidity hole to your advantage. Come in and buy up to that point at which the order book becomes stressed and then back off. Like you're still executing, but it's a little trickle at a time because it's actually more like this. Right? Short move up and then long move over here, right? So during this time, you can be buying a ton more, but you just have to do it slowly. And in this area, you can actually trade more than in this area, right? And then when that impact is died off, you do it again. And that's why they move. That's why it moves the way that it does. So again, it's the same thing. Can you come in and you can say, okay, if I see this pattern, then that means that it's time for me to buy here? No, doesn't, because it's the existence of the signal doesn't predict what's going to happen. But if you know that the meta order is coming, you know that the future orders are coming because somebody knows that those future orders are coming, right? There's a guy that's executing it. He knows that those orders are going to come, right? And that person that's executing it, he will be able to tell you exactly what price is going to do. Almost exactly. It's scary how accurate they can be when you can come in and do the analysis afterwards and you can see where it's going to go to and stuff. And it's crazy when you're watching the DOM and you know that those orders are coming through. And as soon as you see like the big trades here and then the liquidity on the inside is less, it's like it gets stuck there every time. And what it will do? Like that's the thing that's so crazy to me is that if we're going to get this pattern, right? We have the ability to point that out from watching order flow, right? Assuming that we really accurately understand there's meta orders going through. And if we accurately understand that that's not the whole order, you can get a pretty good guess at where this should be too. Although I found that I'm not quite so good at that, but I think that that's kind of because at this point I'm always so weary about taking the risk there. I should be more confident about taking the risk there, but it's usually at this point I'm always asking, okay, is there another leg? I don't always know, right? But that's the crux of the issue. That's the thing that I think retail traders don't understand. They would trade differently if they knew, right? You'd trade differently if you knew. Once you know, like, the impact that the orders have on there, it's kind of like, well, yeah, like, ooh. Yellen saying Russian economy will be devastated. The Treasury moved down 2 ticks there. I don't know if it was off of that piece of news. I don't see necessarily other instruments doing anything that would match up with those correlations. So I think that I do have to chalk that up to the news that we just saw from Yellen, but I don't see why that would move them the way that they did. Retail impact seems very short term, which isn't valuable to longer term traders. Well, I think the path that you're going down, Cyrilex, it's like it's probably pointless to try and build a model to predict what the retail traders are going to do because it's mostly just noise. Like that's why in the models that they develop that's noise traders, right? So they just consider it means absolutely nothing, right? But it's just important to understand that thing about the impact that you can have so that you can understand what matters and what doesn't matter, right? Because when you realize how much new orders coming in will affect the price, now all of a sudden, like, this idea of support and resistance is like, okay. I didn't know that you were from Argentina, I guess. Well, at that point, it's like, oh yeah, support and resistance. This is like the most popular idea in retail trading, really. You know, so first there's technical analysis in general. Next you come to support and resistance, right? What we know about the impact of orders really says that support and resistance is a really stupid idea, right? Because it does not matter how many times it has come back to that resistance. If somebody starts executing a meta sell order here, it's going to go through your resistance. It's going to do it. They do not care that that line is there. They do not care. They don't look at it. They intentionally ignore that kind of stuff because they're more about the efficient execution of it, right? This is the price that it is now. This is how far it's going to move when we execute, and we want to reduce the amount that we move in, because we know that if we turn around and just, you know, exit the position immediately, we're going to lose money. So we don't want to do that, right? So we want this to be as small as possible. And that means that, you know, we'll have less, that it will have to go further from other people buying for us to make our money. Because think about that. If you have a trade and you do this, and then you immediately sell, you get this. Okay. So if we have a trade and we do this, right? Post meta order impact, and then somebody else comes behind me and buys it. Post meta order impact, right? And then I sell it. And I made that much. And I don't know. Is that worth it? Maybe, maybe not. So then it kind of turns into, actually, you might need 2 big moves after you've bought it. Pay attention. And serious, do this experiment for me. You watch CNBC or whatever, and you see some big hedge fund guy come out on CNBC and then announce that they have a position. Go back and try and do the homework and see if you can find where they got into their position. They usually do not reveal that they have a position until they've had 2 moves in their favor, because they know that their impact of them selling would be that, right? So they don't want to risk telling everybody about it until they're well in the money. 2 moves in the money. Just watch. So here at this point, 2.01, I was thinking maybe 05, but you can clearly see how this trade is not going to play out before I'm gone. I do kind of wonder if you can't catch from 01 to 02. But this kind of comes back to this other thing, is like, we have this big order there. It's unusual for sure, but does that mean that they're going to go and touch the order? My research on that kind of suggests that it's random, but don't really have a big data set, big enough data set for that one. Wouldn't rely on the big order. I've not found it to be a reliable trade, even though in this situation it seems like a really dominant thing. I don't know. But what I'm seeing right now is that there's a really big liquidity hole right here at 03.5. So it ain't just going to keep getting sucked back into that unless another really big order comes in. Or rather, I have to say, this guy that's sitting down here waiting to get filled, he's going to have to be really patient if the market is just going to randomly go into him, right? But maybe it could happen after the European close. Could happen. Could happen. So I would think I was making a point there, and then I kind of lost the plot. S&P 500, not so happy today. Has anyone ever been charged for spoofing? Yes, there was. I can think of at least 2 or 3 situations where they charge people for spoofing. I haven't seen anything recently. Oh man, I get it. So if you have HBO Max, they had, I don't know when they added this, but they have a documentary about GameStop. It's very good. And they got it right. Like a lot of the things that people were saying in the whole GameStop thing, because they don't just say, okay, here's the GameStop thing. Like that was one episode. The whole next episode was the aftermath and the charges that, or the accusations rather, that prime dealers were creating synthetic shorts and creating shares that don't exist, which certainly happens. Although the degree to which it happens and has an appreciable effect on the market, at least in that particular instance of GameStop, remains unclear. You would probably need to have the data from the prime brokers to really know how big of an impact that was. But and then there's some of the other things that they talk about that are just nonsense that they didn't bring up in the documentary. And they brought up people that really knew what they were talking about also. It wasn't just like these retailers. Like they had I forget what it's called. It's like Share Intel or something like that. These guys that they really have like the back office data to kind of see if, and they can kind of detect when these things are happening, or at least indications that it might be happening. That they talked about it. It was very good. It was very good. And when you watch that, you really get a real sense of how big the problem is. And when I say the problem, I don't mean like the problem of synthetic shorts, but rather the problem that there are some things that are done on Wall Street that probably shouldn't be done. They are either going to be illegal or are things that I think that we would like to change. But how do you get it to be changed? Because Wall Street has like their influence on Congress is so much stronger than pretty much any other factor, and the congressmen, they don't really understand what they're looking at or what's going on and stuff. So like the way that this works with the banks, and I never did back office operations stuff, so I don't know a ton about these systems, but just from what I do know, what I know is that like if you're on the phone with somebody and they say, "Oh, I want to short X," you don't say, "Oh, nope, sorry, we don't have enough shares to do that." No, you don't do that. You say, "Okay," and if you don't have enough shares, you find them, right? Well, what happens when an aggressive salesperson comes in, makes a deal like that, is going to sell a certain amount of stuff, and then the back office can't find the shares? Then what do you do? Well, you just kind of throw your hands up in the air. And I tell you what happens is that somebody in operations gets really stressed out about it. But then after that happens enough times, they just kind of throw their hands up in the air. And how much that happens and how many shares it is could be, it should never become in all, theoretically, it should never become a high amount. But in practicality, I think in the documentary, they showed a study where they showed that this sort of thing was even affecting the outcome of like corporate governance votes. So it does have a significant impact. What do you do about it? But then really what you got to realize, this is what they don't say in the GameStop documentary. They should talk to me. Come on. I know more than some of these guys they are talking to. It's okay. Not there were some real professionals that really, there's a couple of retail guys like, hey, talk to me. I know more, no more than these guys. But the real reality here is that the whole market structure of the stock market, in particular the US stock market, is unnecessary. Like the whole prime dealer thing, it is a relic of the 70s, man. Like when you had to do a phone call to do stuff, and really what was happening was they were then calling somebody on the floor, and that all exists because of that. Now you have a situation where literally everybody has an internet connection. It can all be done at the exchange, and the whole back office thing, the whole like you have to wait 3 days for your funds to settle and for the shares to be transferred to your account and all. It's not necessary. We have the technology to do it all instantly, but we have the structure that's already in place, right? And it is entrenched. What do you do about it? What do you do about it? I don't know. I don't think you can even fix it. And then it really shows. Then it really starts to hit you like, oh man. Like the retail traders, they made a good trade and it was going to pop off. And then they literally come in halfway through the game and change the rules. Ugh. Okay. So maybe it was just a one-time thing with GameStop. Okay. So then same thing happened this past week in nickel, where some big player got caught going short something and he was going to lose a whole lot of money. And so what do? They shut down trading. They say all transactions that happened after a certain time are null and void. And they wait until he acquires more funding. They bail him out. He should be gone. That business should be out of business. They screwed up. They took a risk that they shouldn't have taken. Here's another case. You let these people take these extravagant risks, and then when they fail, you bail them out. You're changing the rules in the middle of the game. Frustrating. Can you really actually win? Can the retail actually win against these guys ever? I don't know. Kind of seems like maybe no. But if there's a chance at beating them in the game, you have to actually understand the game. You have to know how they play it and what the game is. That's what we're doing here, really. Right? So I'm telling you how they play the game. I'm telling you that the pieces of empirical research that Wall Street bases their trading off of, or at least their execution off of, right? Maybe can help. We would really need to know the rules of the exchange. The whole canceling thing must be within their rules, either by law or by their house rules. Well, I think that their rules may allow this sort of a thing. But I think where it kind of comes into question is like, if you blew your account, they're not going to stop the exchange, right? So like I'm not saying that they're doing something illegal or that they can be sued for it or anything like that. I'm just saying like they literally will like change the rules in the middle of the game. Like for one guy that because he's well connected, he can get them to do stuff. Yeah, exchange rules are being treated just like a YouTube rules. That's a great analogy, man. It's not applied fairly. Yeah, we are talking about something that has an impact on the whole economy, not a private company. We are. If that company went under, it would be a problem. And that would be a problem for the nickel exchange as a whole. And that would be then a problem for all of the related metals markets. And then that would be a problem for the prime brokers that are trying to shore these up. Yeah, because I think it was JP Morgan that gave this guy a bailout. I don't know what you do about it, man. Too big to fail still exists. I suppose too big to fail wouldn't necessarily be so much of a problem if it wasn't that the existence of these too big to fail people are making it impossible for anybody else to be successful. I gotta get going, guys. I will see you tomorrow. I think we should have a relaxing Friday and just kind of have fun. Maybe we can, I don't know. You guys tell me what you want to do. Think about it. And then when we're here tomorrow, we can say what we want. Because we could just argue about technical analysis again. I'm always up for that. But we could try and do something more fun and organized if we want. Yeah. Oh, they blew over several layers of. Yep, they did. Dude, it was members of the exchange were gonna be screwed. So it really was saving the exchange to some extent. All right, guys. I'll see you tomorrow. Stay